Federal Reserve's mandate, one of their mandates is to maintain price stability and maximum employment. Is that fair to say?
Yes.
A lot of folks would interpret that as meaning to aim for the lowest unemployment rate possible without runaway inflation, correct?
Yes, generally.
So I kind of wanted to dig in today with you a little bit about this relationship between unemployment rates and inflation. In early 2014, the Federal Reserve believed that the long-run unemployment rate was around 5.4%. In early 2018, it was estimated this was now around 4.5%. Now the estimate is around 4.2%. What is the current unemployment rate today?
3.7%.
3.7%. So what we had previously thought of, perhaps as far back as 2014, as the long-run unemployment rate is around 5.4%. What we're currently experiencing is 3.7, lower than that estimate. But unemployment has fallen about 3 full points since 2014. But inflation is no higher today than it was 5 years ago. Given these facts, do you think it's possible that the Fed's estimates of the lowest sustainable unemployment rate may have been too high?
Absolutely.
So we overshot in what our long-run unemployment rate is.
I think we've learned, as you pointed out, that you can't identify, this is something you can't identify directly. I think we've learned that it's lower than we thought, substantially lower than we thought in the past.
And I've been seeing lately that economists are increasingly worried that the idea of a Phillips curve that links unemployment and inflation is no longer describing what is happening in today's economy. Have you been considering on that? What are your thoughts on that?
Yeah, very much so. We spend a great deal of time on that. The connection between slack in the economy, or the level of unemployment, and inflation was very strong if you go back 50 years, and it's gotten weaker and weaker and weaker to the point where it's a faint heartbeat that you can hear now. It's still there. You can see it at state-level data and things like that. But I think we really have learned, though, that the economy can sustain much lower unemployment than we thought without troubling levels of inflation. And I think I would look at today's level of unemployment as well within the range of potential estimates, of plausible estimates of what the natural rate of unemployment is.
So why do we think that we're seeing this decoupling in a relationship that we had seen in the economy decades ago?
So one reason is just that inflation expectations are so settled and that's what we think drives inflation. That, for example, when unemployment went way up, you didn't see inflation go down.
Right.
And you don't see inflation reacting to unemployment the way it has, because inflation just seems to be very anchored.
Do you think that could have implications in terms of policy making, that there's perhaps room for increased tolerance of policies that have historically been thought to drive inflation or increase inflation? You know, one of the arguments about minimum wage or other policies that directly target middle-class Americans is that they could drive inflation. Do you think that decoupling is something that we should consider in modern policy considerations?
Yeah, I think again, I wouldn't want to get into the minimum wage discussion directly, but I think we've learned that inflation, that really downward pressure on inflation around the globe and here is stronger than we had thought. You see countries all over the world not getting, being below their inflation targets, whereas when I was young, they were always above. Now they're always below. And the United States has done better than other countries, but we're still below our target.
And thank you. I have one last question. Earlier, you had suggested that in the event of a recession or a contraction, we'd like to see more fiscal policy that supports monetary policy. Can you further articulate what some of those fiscal options and considerations should be in terms of specific options that we should consider?
So I was referring really to a severe or significant downturn, and if that were to happen, then I think it would be important that fiscal policy come into play, and so there are automatic stabilizers that happen. But in addition, things were done at the beginning of the financial crisis in terms of spending increases and tax cuts that helped to replace the demand that had been lost in the private sector and get us through a really rough patch. Something like that. But those are things I would reserve for pretty severe downturns.
Thank you very much.
Thank you.